what's at root of the entire issue is the crypto industry and the banking industry have agreed that they, previously with the Genius Act, that they have agreed that the stable coins, and so these are coins that are pegged to the US dollar, will not generate any interest directly for the holders.
Yeah, no yield.
Yeah, so there's no yield directly for the holders. Okay, so what that means is these stable coins have to be backed by primarily U.S. treasuries. Okay, so we're talking U.S. government bonds. Okay, on a one-to-one basis, basically. Okay, so the way the issuer of the coin makes money is they essentially collect the deposit from the person who wants the stable coin, and then they go and they buy a U.S. treasury, and that U.S. treasury pays an interest, and the issuer of the coin gets to keep that interest as their profit. Okay. And so that's there. And the holder of the coin gets something that's more portable, easier to send around, easier to, if they want to send it cross borders, if they want to, use it to interact with other cryptocurrencies, they can, but even just transacting in regular fiat currency, it kind of removes some of the barriers.
What it sounds like to me, now correct me if I'm wrong, it sounds like a stable coin in that scenario is essentially just a digital dollar. So instead of having a physical one of these or your debit card,
yes,
you're just exchanging in technically USD.
Yes.
And you can't really do much with it other than transact. You can't invest with it. You can't do anything else with it. Is that right?
I mean, as issued, right? But here is the workaround that the exchanges have come up with. So they cannot, be the issuers themselves. They can't issue a yield to the customers. But the exchanges, what they do is they say, put your USDC on our exchange. Okay, put your USDC on our exchange. And then they offer a staking reward. Okay, so they offer a reward to the people who put their USDC on the exchange. Okay, now they're not the issuer directly. So I'm going to look at Coinbase here. Coinbase right now is going to, and this is the Canadian website too. So like this is the .ca version. They're going to offer you 3.35% to put your USDC on their, on their platform. Okay, now how are they making money? So USDC is that's not a coin that's issued by Coinbase. That's a coin that's issued by Circle. So Circle has gone out and issued that coin, backed it on a one-to-one basis with pretty much US dollars, US treasuries, and a couple of other interest-bearing components. Okay, they're making money because they get to keep that interest. But the workaround in the background is these companies are transacting with each other, and so the Coinbase will basically charge a fee to, or Circle will pay a fee to Coinbase. You call it a marketing fee, call it a promotional fee, saying if you attract, if you attract $10 million on your platform, we'll pay you a fee of X. How is Coinbase doing it? They're doing it from the how is Circle earning the money? From the interest on the treasury. So they're not paying it to the holders directly. They're paying it indirectly to the platform, who then passes out some of that to the holder. Okay? And that's essentially the workaround that the banks are unhappy with. They're saying, we couldn't issue, the agreement is that we couldn't issue a yield to the holders directly, but they're basically indirectly getting a yield.
Okay, so let's say I had this stablecoin listed on exchange. Am I getting any yield, or is it strictly just the people offering it? Because to me, it doesn't sound like there's any benefit to me holding this stable coin at all.
You would actually get that 3.35%. Okay. So instead of holding US dollars in a bank account or even Canadian dollars in a bank account, getting 0% at your bank, it's like you have this US dollar stable coin that's on an exchange, a publicly traded exchange like Coinbase, who's audited. And the issuer of the coin. It's not like some, Luna coin that's, algorithmically protected. It's backed on a 1-to-1 basis by U.S. Treasuries, again, issued by a audited company. Okay, so you're effectively getting a pretty low, nothing's zero risk, but you're getting a pretty low risk rate of return. And some people would argue that the risk profile here is actually lower than a small regional bank. Because it's effectively backed on a 1-to-1 basis by U.S. Treasuries by big companies, okay, big audited publicly traded companies. Okay,
so from what I read earlier and what we're talking about here, it's the banks are afraid of people basically doing a run on the banks and getting out of the U.S. dollar, like USD, exactly, and into this stablecoin, because they're getting a yield, they're getting a better return just by holding the currency.
Exactly, yeah. And people are thinking, because of what's happened in the past with crypto, people are conflating this with other instruments that weren't backed on a 1-to-1 basis. They were backed on some algorithmic basis, or, they're thinking USDC is the same as Dogecoin or something like that. It's an entirely different instrument. If this was just Dogecoin, the US banking industry wouldn't care. They would just make fun of it and tell you to put it on here. The reason why they're fighting this is much bigger than Donald Trump. This is the U.S. banking system versus a new technology. This is what this is. This will be around long after any administration is here.
Oh yeah, I mean, Donald Trump, he's got 3 years left, 3.5 years ish. No, 3 years. Basically 3 years, and he's out. He's gone. So anybody who is making this about Trump or Trump's administration, this goes, like you said, far beyond this administration and the next.
Yes.
And the next after that. Okay. Are we going to get to the point where how this affects Canada, or you still got some more runway on?
There's still some more, because I'll get the ones where, like, this is capital flight from the entire banking system. Like, this is deposit flight, not just from U.S. banks. This is deposit flight from Canadian banks and virtually every bank around the world. Okay. Because they've enjoyed taking large deposits and giving next to nothing on interest for decades now. Okay, so it's structurally going to change the entire banking system, and the U.S. government it's not just as simple as side with the banks or side with the crypto exchanges. There's a lot more going on here of why they need these coins. So some people would say, like, well, they don't need it, cancel it, just get rid of USDC. Let's side with the banks, right? Or let's just side with the crypto exchanges, and as if that won't have any change on the way banks take deposits and make loans in the future. It's like we're going to have a shift here, one way or the other, right? But I want to show people, like, why these coins, which people think are just like they're conflating these stable coins with some sort of meme coin or something like that. This is wildly different. This is why this is at the heart of the financial system. Okay, so we talk a lot about the U.S. national debt. Okay, yeah. The head of the beast, $38 trillion. We're going to have a $39 trillion debt at some point, right?
Soon.
And so every time the U.S. government overspends, $1.7 trillion every year, they have to find someone to take on that debt. Either an institution or an individual investor. They have to find someone to borrow from. The Treasury issues the bonds, and if no one buys them, the central bank has to buy. The Federal Reserve steps in and is the lender of last resort. Okay, so what that happens is that essentially increases the size of the money supply. And so we're looking at the last 10 years of the U.S. money supply. Even after basically this 3 years here is, the last 3 years is, some of the tightest monetary policy we've had in a very long time. Okay, basically in the last 3 years, it's gone nowhere. Okay, but even without that, in 10 years, they've gone from 12 trillion to 22 trillion. Okay, and so that is a 6% growth rate, even after putting the brakes on as hard as humanly possible for 3 years. That's right. All they got it down was a 3% growth rate. Okay, and I'll compare that to, I think I might have the population here. So Compare that to the population. The population has grown from 323 million to 344 million in 10 years. It might look a little more a little larger on this graph here, but like just think about it: 323 to 344. 20 over the 34, divided by the 344. It's less than 1% per year. Yeah. Like this is less than 1% per year. And so this is like, it gets the heart of the real inflation, not the government CPI numbers. I mean, the real inflation, the real purchasing value of your dollar. Okay. And when you have the currency expanding at a rate of 6% a year, and the population's only growing at 1% a year, there, I just, we can calculate inflation different ways. Sometimes you look at it and we relate it back to the, gold, but basically you have a currency expanding at 6%, population's only 1%. Inflation's at least 5, people. Like it's at least 5, and it's been 5 for a decade. Like that's smoothing it out, right? This is not Putin's price hike. This is just overspending and expanding the currency supply, right? Like this is what the number is. Okay?
Yeah, so we're getting closer to 20 billion Zimbabwe dollars. Getting closer and closer.
So they need to find borrowers for this, okay, because they're not balancing it. So the supply of U.S. treasuries available is increasing and increasing. And what they don't want to do is put the whole thing on the Federal Reserve balance sheet and start a debt spiral, basically. That's not what they're trying to do, okay? So, these are the instruments that people end up buying. These are the short-term 3-month treasury bills, okay? So the 3-month bills, we're looking at, in the last 10 years, people have been making somewhere between, let's call it 0.25%, and maybe for a moment in time, you would have got 5%. So you just look at that mean here where maybe you're getting 2.5%, okay? Keep in mind, you're holding something that's decreasing in real purchasing terms by 5%. It's decreasing by 5%. They're giving you 2.5%. Okay. What if I go out on the longer term here and I look at the U.S. 10-year Treasury yield? Okay. So now you see where, this thing didn't get to 5. I think that's a hard red line. I think the market is looking for 5%. That's an Armageddon type event. That's a stock market crash event, right? You see it just top out there at 4.8, and there was a lot of intervention and announcements that happened around that point. So we're looking at this, that, we're talking that, this also 3%. Maybe right now today they're getting 4%, but how long will that last? Okay, even if it is 4%, it still doesn't fix the problem. It still doesn't fix the problem where if I'm a sophisticated investor, a long-term investor, that I have an item that's growing by, in real terms, like real population adjusted terms, by 5%. So it's growing by 6%, but let's say if I can normalize for the real productivity for individuals that it's 5%, I'm still only getting 4%. Best case scenario, I'm eroding my capital over time. Okay. And this isn't like me being a contrarian or me being, a conspiracy theorist. It's like, you can see this by the activity of central banks around the world. Okay. Where they have been, you hear this term de-dollarizing. And what does that mean? Okay. So somewhere in and around, 1994, central banks around the world started to pivot off of gold. Okay, they started adopting U.S. Treasuries as their primary reserve asset. Okay, and that trend has basically been the same for the last 30 years until now. Where we have central banks around the world. This is not me. This is not me or my clients buying 1 ounce gold coins for $7,000 Canadian these days, right? But this is central banks buying tons of gold because they don't want to get inflated away. They don't want their purchasing power to be eroded over time. Okay, so we have this. At this point in time in 2025, central banks around the world have basically said that we think gold is more important than U.S. Treasuries.
Isn't that something?
Not the Bank of Canada.
No,
but,
no, of course
but
not. Right?
On an aggregate across the world, what I'm saying is not, it might sound contrarian here, but across the world, it would be the consensus view that gold is more important of a reserve asset than the US dollar because the US has no functional way to get this spending in line. So all they're going to continue to do is expand the monetary base and inflate their debt obligations away. So the best math that you can assemble is, they increase the money supply by 6%, the population grows up by 1%, that real purchasing, I would need a return of 5%. And in order to stay whole, not even to increase anything.
Just to break even.
Just to break even.
Yeah.
And I'm going to get 4. This is a loser long term. I need to rotate my capital out of here strategically, slowly, consistently over time. And that's what's been happening, right? That's what's been happening. And that's where I tell people, like, a 4% rate of return on fixed income products, a 3% rate of return doesn't make sense. You were just eroding capital, you were just eroding your purchasing power over time. The banks will gladly sell it to you, but sophisticated central banks around the world realize that that's not a good allocation of capital. Okay, the banks will sell it to you, and sometimes psychologically people want to accept the number going up slowly is actually increasing, but it's decreasing their purchasing power.
Well, it's because inflation is so nefarious, and you don't see it. Like, they tell you the number, they come out and say, our inflation is 2 points or 3 points or whatever, but in reality we don't actually see it. It's not like something that hits us in the face like a direct tax.
That's right.
Right? It comes out in the form of what you're purchasing at the grocery store, going out for dinner, or fuel prices, or things like this. So it happens so slowly and so behind the scenes that people don't recognize it. But regardless, you are losing the purchasing power anyway. So like you said, individuals, if they're in a bank fund or something like that, some kind of mutual fund, they're not going to notice that. But they will see it in their statements, because it'll show that, it went up this much and went down this much, and basically they're about the same as they were the year before. So they're not really gaining anything once you take out all the fees and management and all that stuff. So getting gold. So this is on a massive scale. A country is way different than an individual, right? So they're buying tons and tons of gold. What happens when that supply runs out? I mean, there's a finite supply of gold.
The price goes up, right? I mean, gold does increase, historically about 1% supply every year, which is 1 to 2% actually every year, which is strangely enough the desired target for inflation. That's the uncomfortable part for people who say we're not on a gold standard. Like they pick this arbitrary 2% number based on the expansion of the gold supply historically over time, which is interesting. So we know sophisticated holders are actually selling U.S. Treasuries. So they're actually reducing their exposure to U.S. Treasuries over time and buying gold. So that's a problem for the U.S. because they don't want to balance the budget. Okay, so they don't want to balance the budget. So who's buying it? That's the question. Who is buying it?
Who's buying what? Treasuries?
Who's buying the Treasuries?
Good question.
So now we get into the stablecoin issuers. Okay, Tether is the largest stablecoin issuer. So Tether was, I believe it was originally founded originally headquartered in Hong Kong, and now it's moved to El Salvador. Okay, which is kind of important. This is a trend where people start to realize, and so they have backed their because they're not in the U.S. They can kind of choose what they back their stablecoin with. It's still primarily U.S. Treasury. So you start to look at this allocation. It seems like actually a pretty smart allocation. It's audited by BDO, and they have 76% in cash and cash equivalents and other short-term deposits. So that is effectively mostly 83% of that 76% is U.S. Treasuries. The other part is overnight reverse repurchase agreements and term reverse repurchase agreements. Okay, you can also see that they're actually 9% in precious metals and 4% in Bitcoin. It's actually a very interesting mix that they pick, And, if this is, the risk is like, is this true? They're based in El Salvador. Like that is like, that's a legitimate risk factor. But, I think it's, at this point, the history says something. The fact that it's audited by a big accounting firm says something. Okay. And that is a reasonable allocation for stablecoin. And that's why it's the biggest one. And you can see a lot of people around the world might not, they might actually prefer Tether that's not headquartered in the U.S.
Right.
Because they're worried about, the sanctions being harsher in the U.S. Okay. And so this is big money, people. This is like, I want to look at this number on the screen here. This is 192 billion with a B. Okay. $192 billion. Okay. And to, put that in perspective. Well, let's look at the other one first, and then I'll put it in perspective for people. The other one is the number 2 largest stablecoin on the planet is USDC, okay, which is Circle. And Circle has about $70 billion in circulation. And Circle is, I don't know, see if I can find it here. But essentially, it's actually just right there. So they have 3-month treasuries here. They have overnight reverse treasury repo. So they got aligned directly with the Federal Reserve.
Yeah.
This is how ingrained this stuff is, directly with the Federal Reserve. Okay. And these are the purchasers. So I want to put in perspective here. This is $270 billion backed primarily by U.S. treasuries. $270 billion. To put that in perspective, I heard some people saying, I was like, well, Carney could just sell the U.S. FX reserves to hurt the U.S. Okay, these are we pulled this a couple times now. Canada has $68 billion of U.S. reserves. Tether has more.
Wild.
Tether has more than Canada. Right? Tether has probably double the U.S. Treasury bills than Canada does.
What I find so funny is all the posturing out there by pundits on the CBC and MPs in Ottawa and other places, just posturing how strong Canada is and how we become our own best customer. It's like, man, you're completely lying to yourself and to the Canadian public as to how gigantic the U.S. market really is and how insignificant the Canadian market is.
Yeah, you start to get where, like, Tether, for example, is like top 10. If you look at Tether as a country, the U.S. for FX reserves would be top 10, I believe number 5 even, right? So you're talking like it's bigger than Germany, bigger than Saudi Arabia, right? And it's just growing massively. And so people will say, like, okay, you should, you could just shut this down. I was like, okay, you
and implode your currency.
Exactly. Exactly. Right. And so if you shut it down, they have no use for, like, that means people would redeem their stable coins. They have to make those individuals whole. And in order to make them whole, they have to sell off the U.S. bonds that they've acquired. And so this is not as simple as they could just side with the banks and get rid of these stable coins. This is not Trump coin. This is not Dogecoin. This is the U.S. Treasury market at this point. This is hundreds of billions of dollars of U.S. Treasuries.
So you could liken this to essentially it's a cryptocurrency completely backed by the U.S. dollar. So it's almost, I don't want to say it, almost CBDC, almost-ish. Not quite, but it sounds like that. So it's basically U.S. dollars in the form of a digital stable coin on a network.
That's right. And they need demand. The U.S. needs demand because foreign investors are getting off the train. They're getting off of this. It's too slow, right? So they're pivoting. They're getting away from U.S. treasuries, but people around the world still want U.S. dollars. But a lot of people around the world can't get access to U.S. dollars, right? Even a lot of people in Tier 1 countries would rather use a stable coin because they can transact across borders better, or simply they can just get a better rate of return,
Right.
So that's why they're holding this
Well,
stuff.
think about somebody, let's say in Philippines, they could buy this, could they not?
Yeah. So someone from the Philippines who wants to hold basically US dollars instead of holding Philippine pesos, or someone here in Canada who just doesn't want to leave $100,000 sitting at RBC getting 0%.
Right.
Like the interests are aligned here, right? And so the US government needs stablecoins because they're running out of people to sell treasuries to. And this is now their main buyer. It's been the growth buyer for years at this point, right?
Yeah.